Hey, what's up, everybody, and welcome back. Good morning. Hey, it's the Mike Drop Show. I'm Mike Morawski, your bounce back coach, your multifamily bounce back coach. I'm here every Wednesday morning to talk real estate, business, and life. Hey, sometimes I bring on some amazing guests, and sometimes it's just me, like today. You know what? If you know anybody who would be a great guest on this live on Wednesday mornings, please reach out to me. Give them a nudge, tell them to reach out to me. I would certainly love to have an interview here at any time. Today, though, I'm going to address some hot questions that have come up over the week. You know, after three decades of being in the real estate business, I've seen investors win big and lose hard. You know, the difference comes down to strategy. It comes down to timing. You know, when I talk about timing, I say there are no geniuses in this business. There's only market cycles. And absolutely no doubt right now, we are going into a market cycle where you are going to be able to benefit from it. This market is going to start to rise up, whether you're a passive investor or an active investor. Take advantage of the coming months, the coming years of how this market cycle is going to cycle up. But my mission is to give you tools to grow smarter, avoid mistakes you might make along the way that typically would take people out of the game. So I've been getting a lot of questions over the last couple of weeks. Some of them are multiple questions. Some of them are new. But I'm going to address a few of them here this morning, and we're going to talk about a couple of different things. But one of the questions I get, you know, rates are high. You know what? And really the whole question is rates are high. How do I vet a seller finance deal so I avoid a trap? Well, there's two different questions in there, right? First of all, rates are not that high. They're really at a normalized rate. You know, I heard somebody yesterday tell me that they were doing a buy down on a $30 million apartment complex. And by doing that buy down rate, their interest rate was going to be about 4.75. So our rate's really high. You know, when your rate is below your cap rate, you're in a positive yield position. And why not take advantage of being able to be in that positive position so that your deal cash flows better? But, you know, when I first got in the real estate business back in the early 90s, we were just coming out of double digit interest rates. And for people today to say that 6-7% is a high interest rate, I find that kind of interesting. You know, I remember back when interest rates were 10%, 9%. And even before that, they were 17, 21%. But I remember when interest rates were 9 to 10%, and we used to say, boy, I wish I could buy a house at what my parents paid, you know, had an interest rate, which back then was like 3%. Well, you know, believe it or not, interest rates fell to that 2-3% range. And, you know, it took 50 years to get there, right? So, you know, real estate is cyclical. Will we get back there again? Yes, we'll get back there again, but it's not going to be for a number of years again. The market has to do what it's going to do, and it's a natural progression. But interest rates today are not that high. There's a lot of advantages out there. You know, you can do agency debt, which is typically cheaper or less expensive interest rate than what you're going to find in traditional financing. There's all kinds of buy down programs. You know, there's also two types of loans, right? You can do a floating rate debt and you can do fixed rate debt. You know, I have a friend that he and I always get in this conversation about floating versus fixed. And I'm a fixed rate debt guy. I believe that I want to get out of bed every morning and I want my mortgage payment to be the same monthly payment as always, because that way I know then if there is a spike in those interest rates, I'm not affected by that in any way. Buy downs are a good way to take advantage of lower interest rates today. You know, raise a little bit more money on your syndicated deal, put it on the loan to buy that rate down, and then you can even do fixed rate buy downs, which is really interesting. So the second half of that question, you know, how do I vet a seller finance deal? You know, here's what I will tell you. I think there's a series of questions that you need to ask a seller. And then you need to do your due diligence on that property, just like you would if you were doing any other transaction. So it doesn't matter whether it's a seller finance deal, creative financing, or whether it is, a traditional type of financed deal. But you can avoid the traps along the way, right? You can avoid those pitfalls, those mistakes by making sure you have enough data, enough information, and you ask enough questions. I'm going to be doing a creative financing session. If you come to my multifamily summit next week, and for those of you that don't know, next week on October 16th and 17th is my 6th annual multifamily summit. It's a 2-day event. I have 20 speakers and panelists who will be speaking at the event for 2 days, just pouring into you their gift of knowledge, experience, what to look for, what not to look for. We're going to talk about everything from mindset. Dr. Jay LaGuardia is going to be on, and he brings a different twist to mindset. And, this just happens to be a game that we need to keep our mind right. We need to stay focused and stay committed to the process, because people get fatigued in a down market, and we're at that fatigue place. And you can start to see it with all of the fundamentals. But Jay's going to talk about how to stay in the game. And he brings a different twist to mindset than some of the other mindset people out there. I'm also going to have Hunter Thompson on, who's going to talk about the markets and raising capital in these markets. I'm also going to have Michael Guthrie on, who also is going to talk about raising capital. There's a host of speakers and panelists. We're going to talk about 1031 exchange and self-directed IRAs. So this is an event you won't want to miss. The incentive is that you're going to get a free ticket for the 2-hour event that I'm going to do, the master class on creative financing. We are in a market right now where there's the best opportunities out there to buy deals creatively. And I have bought single family homes, 4 units, 40 units, 100 units, 400 units, doing creative financing, owner financing. There's a lot of different terms for it. There's subject to, there's land contracts, there's owner financing, there's lease to own. So whatever tag name you want to put on it, come to the class, because I have one tool and one technique that I love and I use every time. See, by being able to do creative financing or owner financing, what it does is it gives you the ability to control a deal. And real estate's not about ownership as much as it is about control. How much control do you have on that particular asset? And so how do we structure that? Back to the question, which was, how do I vet a seller? Well, I have a list, and you're going to get this at the event, the creative financing event, of 10 questions that you want to ask the seller. And you want to get enough information and enough data. And so I hope to see you at the summit this year. You can go to multifamily25.com, multifamily25.com, and get registered. And then you'll also get free access to the masterclass 2 weeks later on creative financing. So we have a couple of big things happening here in the month of October. So I look for you to participate with us. I have another question here. We have a 24-unit value add multifamily property. Should I do a joint venture, a JV deal, or should I syndicate that deal? Well, here's what I would ask. Who's your partner going to be? What's your access to capital, to that equity? And is it one investor? Is it 2 investors? Or is it going to be multiple investors? I always say, if it's multiple investors, more than 5, you probably should syndicate that deal. If you have less than 5 investors, you could probably do a joint venture. Now, a joint venture is less expensive to put together. It's easier to manage, easier to operate. The structure is a little bit different in splits and profits, and your promote on the back than what you would typically do in a syndication. But it's simpler. And a lot of times keeping the deal simple and keeping it easy works well. There's this thing in multifamily called a waterfall. And waterfalls kick into place for a sponsor and an LP when you hit certain thresholds or hurdles in that deal. And I tend to not use waterfalls because it complicates it. The average passive investor just wants to know that it's a 70-30 split. They're getting 70% of the profits. The GP team gets 30% of those profits. And it runs that way. When you start to inject waterfalls or hurdles, what happens is those typical passive investors tend to get a little leery about the deal because it makes it more complicated. So I always say keep it simple, right? Do a JV if you can do a JV. Keep any waterfalls out of it. Have the splits be straight and equal and create a win-win situation on every deal. How about this question? Top methods to reduce taxes in year one on a multifamily deal. What a great question, right? So I had a couple of questions from new investors this week. So how do I use this tax planning strategy to my advantage? And one way, and we're going to talk about this at the summit. At the summit, Kevin Cawley with CSSI, that's Cost Segregation Services Incorporated, is going to be speaking at the event. They're one of our sponsors. And what Kevin does is he teaches how to use cost segregation. Cost segregation is an engineering study. It's a third-party study that depreciates the real estate at different time frames. You know, paint depreciates different than floor coverings. Roofs depreciate at different time frames than doors and walls and windows. So an engineering study lays that out and works within the tax code in order for you to accelerate your depreciation in the first couple of years, take more of it, have more write-offs, and put more cash in your pocket. So if some of that's confusing to you and you want to know how to use it more, make sure you're at the summit this year because Kevin's going to talk a lot about that and it's going to be helpful. Another question was, how do I protect LPs from surprise capital calls if the market gets rough? You know, I don't know that there's ever any way to protect a LP from a surprise capital call. You know, it needs to be talked about up front that there's the potential there could be a capital call. It needs to be written in your offering documents. There's a lot of moving parts with capital calls when that happens. If an investor doesn't invest when there's a capital call, they dilute their investment position. If an investor does invest, it keeps them, at that same position, but gives them a little bit, more capital investment into the deal. Unfortunately, capital calls sometimes are not avoidable. If you don't have a property that's cash flowing, that occupancy's dropped, expenses have gotten high, that operations have fallen, I just say it again, and I say it again and again, because I believe this more and more today than I ever have. There's no geniuses in this business. I listened to a webinar this week by somebody, and I'm not going to talk about the sponsor or who it is, but they said that, they had a fund and their fund invested in a bunch of other operators, and they were kind of throwing operators under the bus saying, operators not doing a good job and this and that. But when an operator is up against a whole lot of issues that didn't come up early on, and those issues could be, you could have a fire in a property. You could have a shooting at a property. People die, people move out, rent skip, people lose their jobs, medical issues, people have to move out. Your occupancy drops. When your occupancy drops, or you have to give a lot of rent concessions, or you have to give 3 months rent, or you have to drop operating, or your operating expenses increase, but the rents don't increase enough to match the operating expenses. Sometimes a capital call is evident. And, it's just part of the nature of investing. And, in alternative investments, there's things that happen. And, unfortunately, they're most of the time unpredictable. I have a very good friend who's been in the business for a long time, and he he was very fortunate in 2021 to top tick out of some deals. And those deals that he got out of were deals that today, those operators that bought those deals are in stressful situations. They're struggling with cash flow because they bought so high at a price and the operations don't match the price. So, there's a lot of things. You try to vet things as much as you possibly can along the way. But you know what? You can't always call every shot early on. It's like creating an exit plan. How are we going to exit a deal? Are we going to refinance if the market is conducive and we can refinance, do a cash out refinance, pay back some capital to our investors? Or are we going to have to wait 5 years? Do we have to extend the deal life for maybe 7 to 2 more years to 7 years? There's challenges in a lot of deals out there today. Some deals don't have challenges. And, fortunately or unfortunately, I'm involved in both. So we learn along the way and we continue to educate ourselves. And you do that by talking to people that have been involved in the business, are involved in the business. How are they managing? How are they mitigating these situations? You get a coach. So many times we're in a position where if we don't have somebody else around us that we can go bounce ideas off of, get input. One of my coaching clients is a builder developer in Atlanta, and, he knows the business. He knows how to underwrite. He knows how to find deals. He knows, how to structure debt and financing and the capital stack. He knows everything. But you know why he has a coach? He has a coach because strategy is really important. And mindset is really important. And I bring both of those to him and helping him continue to grow his business. And he's having a phenomenal year as a result of it. Problem free? No, not at all. But he's having a great year as a result of it. So a coach, a mentor, somebody who can, help you along the way to help you see something a little different than the way that you're seeing it is so critically important. Well, that's a wrap for today. Boy, this time goes fast on Wednesday morning, but that's the Mic Drop Show. Hey, if you want deeper training, join me next week, October 16th and 17th for the 6th annual Multifamily Summit, where we're going to be soaring into different techniques, strategies, people's passion, where the market is at, different tools that you can put in your toolbox to use. I'm going to give you the blueprint, the playbook, everything that you need. Get your seat because they're filling up fast. We're having a great call this year for people coming to the summit. So seating is getting limited. So make sure you go to multifamily25.com, multifamily25.com. Get registered today. Remember, you're going to get a free pass to the Creative Financing Masterclass. That'll be 2 weeks after. So if you like what you heard this morning, if you got one little nugget out of there, I did my job. But hit the subscribe button. Do me a favor, like this, share it with somebody who needs to hear it. Tell somebody about the Mic Drop Show on Wednesday mornings, and be here next week. Hey, everybody, I look forward to seeing you at the summit. We're in Vegas tonight doing a live event. So if you're in Vegas watching this, look forward to seeing you tonight at the meetup in Vegas. If it's a new location and I don't have the address in front of me, if you're looking for it, DM me and I'll get it to you later today. But take care, everyone. Have a wonderful day. We will look forward to seeing you at the summit again in the Creative Financing class.